I want to, in this short video, give you an introduction to some advanced trading strategies. People are sometimes curious about these, and I thought it'd be a good opportunity, just as I say, to give you an overview for now, before going into far more detail in my other videos. And these advanced trading strategies apply not just to foreign exchange, but to commodities, to equities. And this is the starting point. It'll be a screen like this. Software like this is freely available. And in other videos I'll tell you how you can get it and also what I use. So what you see in the upper bar in green up here is the price, and that could be anything for argument's sake. It could either be currency, it could be the price of gold, it could be a stock, and it could be across any time frame. So each one of these little vertical lines could represent anything from 1 minute to 1 day, depending on the time scale across which you're trading and the time you have to devote to trading. Once we've got a setup like this, then what happens with advanced indicators is in the lower part of the screen you'd have one of these indicators. Now, there are a couple of major types of indicators. One of the category is what's called so-called momentum indicators. These are things which you may have heard of before, such as the RSI, which stands for the relative strength indicator, or the MACD, which stands for moving average convergence divergence, or the stochastic. And what all of these have in common is that they are indicators which tell us when to buy and sell based upon the movements of the share price, and they're actually mathematical indicators. So what they do is they, based on the share price, calculate when might be a good time to buy and a good time to sell, based on the notion that prices move in waves and run out of momentum. So when prices rise very quickly, they tend to then run out of momentum, run out of energy. People have bought all they want, and therefore prices fall back. And then once they've fallen back for a while, people have sold all they want, and they start buying as things overshoot and become cheaper. So that's the essence of momentum, and they work, as I say, as mathematical formula. They draw these lines, and based on these lines they have rules. So with the RSI you would have a rule that when it changes direction, such as in these areas, that could be a good time to buy. And as you can see, the price has tended to hit lows and then rise. Now, they're very general rules. They're rules based on observation, based on a logic, which is that prices tend to exhaust themselves and then rise. They're based on the mathematics of prices, so they measure in different mathematical ways. They measure when a price has fallen a certain amount, whether a percentage or from a given time frame, and so on. We don't need to know the mathematical formula, but you need to know the internal logic, which is just simply that when prices they move in waves, and when they run out of steam, they then tend to change direction. And that's what they're trying to do. They're trying to depict exactly that. And in depicting that, what the prices are doing in depicting that, what the indicator is doing is giving you a point at which to buy, a point at which to suggestion at which to sell, and that of course is all we're after. So they tend to have simple rules, and all you do is you're really following the rules. They don't work 100% of the time, nothing ever does, but the idea is that if something works 6 times out of 10 or 7 times out of 10, that's pretty good, because of course a coin is right 5 times out of 10. A coin is right 50% of the time. So that's the basic notion, and that's how all these advanced strategies work. So let me show you the RSI again. One rule with the RSI is sell when the RSI goes below 50. And you can see here, that's the RSI indicator. And as I say, software will freely provide this. There's the 50 mark. And as it moves below 50, we might tend to sell. And you see the price, of course, expected to go in that direction. Similarly, there are other indicators which are based more, again, on the principle of as prices move to extreme, so that if prices in a short space of time move too far in one direction, they tend to move back. And this is here what I've drawn, what's called the Bollinger Bands. And it just so happens that I've used a currency here, but it could be gold, it could be stocks. And you see these bands, and what these bands are drawing, they're based upon the average that a price moves around any given level, and it works on the basis that if it moves too far away from its average, then it'll pull back. So when it hits an extreme buying area, when it hits a double bottom, it sort of makes a bottom and then touches the bottom again, a double bottom, you would tend to buy, and you see another one here. And similarly selling near double tops. That gives you buy and sell ideas. That's the Bollinger Band, and you can see that they can be quite accurate and give us quite good ideas of when to buy and when to sell. As I say, these are advanced strategies which I'd go into far more detail, including giving the formula in my fuller videos, but for now I just want to give you an overview because people often ask me about advanced strategies. Similarly, with advanced strategies, you could have something around resistance levels and the 200-day moving average. So here you've got a resistance. Why is this a resistance? Oh, well, look, notice I've drawn this red line. And that's a resistance level because the price hits it, then drops back, hits it, then drops back, hits it, then drops back. So we can draw that line as a resistance level. And when the price breaks through that resistance eventually and is above the 200-day moving average, then that's a buy signal. Why should that be a buy signal? Well, the idea is that the price in the past has not been able to break through that level. When it does, it suggests that the buyers are really there with some force. They've done something they've not been able to do up till now, and therefore it must be a good point at which to buy. And therefore, what we say is that is a buy signal. Why then add this extra confirmation of the price being above the 200-day moving average? Well, remember with our simpler strategies, we discussed that when the price is above the 200-day moving average, it's above what average it tends to be. And therefore, if it's above what it tends to be on average, then it suggests that it's got some momentum. There's some energy behind it because it's above what it tends to be on average, and therefore the buyers are saying, look, this is really good. Let's move it higher because it really is and has got some traction here. And so it's a confirmation. We go for two things. One, we go for the price breaking through a resistance, and there's a logic behind it. Remember, the logic is behind it that it hasn't been able to get through there before. Now there must be more buyers than ever before because it's got through it. So that's one logic. And the second logic is it's above its 200-day moving average. But there's two other things I want you to note about that which you might not have realized. The first thing is that we look for confirmation. So we're not just looking at breaking through resistance, but we've also looked at a move above 200-day moving average. So that's confirmation. That's a technique used often by traders. They look for confirmation. And the other confirmation we looked at is we waited for the price to move. We didn't just get in. We waited for the price to tell us when to get in. That's it, moved above the support line. That's what's called confirmation as well. So we've got two confirmations here, and that's always a good thing to do with trading. Now, here's another advanced strategy. You place a stop above. This is with foreign exchange. This one applies to foreign exchange. And for those who are into foreign exchange, you work out when the Asian session closed in a particular currency, and you work out what the high that the price in a currency, for instance, it could be sterling yen, was during that period. So when the Tokyo markets close, that's the close of the Asian session. You place a point there as a stop, and you sell when the London is open and it breaks down on the downside. So what you say is, as soon as London opens, sell London, breakout down. What happens is when London opens and it breaks lower, you're looking to sell. How do you know when you're wrong? Your exit point or your stop losses, which I've discussed in other videos, that was the high for the Asian session. And what that does here as an advanced strategy, which is based on, applies only to foreign exchange, is first of all, it gives you a point at which to short the market and sell London breakout downwards, but it also gives you a stop loss at the Asian high. Why should that work? Why do these things these sometimes just sound like random things? Well, actually, sometimes they work because people have observed them often enough and said, you know what, 6 or 7 times out of 10, this works. Nothing ever works 10 times out of 10. 6 or 7 times out of 10, it works. And that's often how these things operate. They work on the basis of observation. People note these things and they say, right, okay, I've observed this many times. Now, again, I'm only giving you an overview at the moment. All of this is to be given in far more detail, but I wanted to give you an overview of what we do when it comes to advanced strategies. Let me give you one more advanced strategy, very popular. I'm going to give it again. I'm giving it in foreign exchange an example, but it could be commodities, could be stocks. And the idea here is what we call in the 1, 2, 3. Okay, and the way it works is we look for 3 moves in the price. You're looking for, first of all, a break. You've seen this move up, then you've got a move down, that's 2, bit of a move upwards, 3, and then when it breaks below 2 over here, that's the point at which you sell. So that's when you expect it to move lower. Now this is, for those who know about it, to do with Elliott waves. The break of a trend line on the indicator is something that you look for confirmation. Here we've got an RSI. You can see this trend line. The trend line or support is where an indicator or the price just touches it and bounces off, touches it, bounces off, touches it, bounces off, and you can draw a nice little line. When that breaks as well, it suggests the price is going to break as well, and that's where you sell. You wait for that break of that price. So you've got the move 1, 2, 3, and when you get that break below what was at 2, from when it went to 3, that was it. You move low. Now again, I'm only giving a very quick overview. We need lots more examples to look at these, but you can see, first of all, we waited for the price to break. We waited for confirmation. And what's the principle behind this? Well, again, the simple principle is prices move in waves. So they may well go up and down, and what we're doing is trying to find rules around that. And here the rules that we've found is 1, 2, 3, and then it goes below 2, we get in. Yeah, so that's the notion with waves. As I said, we're giving an overview here, so don't worry if I'm going through this very quickly. Another one in terms of advanced strategies, buying dips. This is now foreign exchange I'm going to focus on again. Buy dips during European sessions. So when the European markets are open, the London markets, you'll often get moves, dips. Again, prices moving on waves, and you see it, you go. As soon as you get a bottom and it starts rising, you buy, and then it starts to decrease. You know those are the selling areas. Buy on those dips. Very often that works as a good, fairly advanced strategy. You've got to be able to look at the market. You're looking at this because you've got the time to be in front of the stocks, in front of the screen, and you're looking at it during the course of a day. The whole point with all of these advanced strategies is that you've got a lot of things in your armory. However, one thing you've got to remember is you don't need an advanced strategy in order to buy or sell. All you need is 1 or 2 strategies. They can be simple or advanced. We will look to find things which work for us, which we like. I'll explain the ones I use, and you will actually only settle on 1 or 2. You don't need to know and memorize hundreds and hundreds of them. It's the mistake many retail investors make, but professional hedge fund managers don't make, actually. We tend to be a lot more sensible with these things, and we know that in actual fact we only need to be right at 6 or 7 times out of 10, and therefore we only need 2 or 3 simple strategies that we memorize. The reason I want to give you all of these is then you can pick which you like the look of, which you like the sound of yourself, and you focus on those, you stick to those instead.